Hey everyone, John Henry here, slingshotfutures.com, and today we're going to be taking a look at candlestick patterns, part of our YouTube mastery class. Now, these are going to be the primary candlestick patterns. These are by no means all of them. There are hundreds of them, but these are the most commonly used and some of my favorites. I'm going to teach you what they look like, how they form, and variations to the formations and information they give you. Now, we're going to be covering the inside bar, otherwise better known as the harami, if you're a fan of candlestick names, the outside bar, which is an engulfing candle, one of my favorites, the twin reversal, and we're also going to be talking about hammer and star patterns. So first up on the list, we're going to be taking a look at the inside bar. Now, this is a candlestick that forms when the market can't achieve a new high or low beyond the prior candle. It is literally inside the prior candle. Now, this can show several different pieces of information, and it all comes down to the context of the market situation at that time. It can be the pause before a breakout. It can show confusion in the market and maybe a little hesitation. Often, very often in fact, it can lead to false breakouts on either side before seeing the actual move occur. Now, this is a good example of an inside bar on the right side here. The inside bar being the one highlighted in orange, this little bull bar right there. Now, this bull bar formed completely inside the first big old bear candle, the one highlighted in orange, and it's, again, literally inside the prior candle. Little side note, the reason it's called the harami is because that is translated into pregnant, right? It's kind of like with a baby. It's kind of in the middle, inside of the prior candle, so it makes a lot of sense in that regard. Now, this could be showing either a pause in the market before a breakdown or weakness, with traders not trusting that large bear candle. The information that the candles give you after the pattern has formed are just as important as the pattern itself. So always make sure to look at how the reaction to this pattern or any pattern, what are they doing? Are they reacting the way that they're supposed to? Are they showing maybe they're a little nervous? Are they showing a huge amount of confidence? That reaction can be a major clue in how to treat and approach this type of setup. The next one on the list is going to be the outside bar, or better known as the engulfing pattern. And this formation occurs when a candle finishes with its highs and lows beyond the prior candle. So this can show several pieces of information as well, like major strength in an existing trend. But it can also show major weakness in an existing trend. Often it can lead to either a really strong continuation or a complete failure. As always, it depends on the context and the location. Now, this is an example of an outside bar in blue here, massive bull candle, but if we look, at one point, remember, the candle opened here, and they tried pushing down. They broke below the prior candle's low. And after they did so, they slammed all the way back up through that prior candle's high and literally engulfed the entirety of the prior candle. Now, in this type of context, it could be showing an immense amount of strength by the buyers, or, depending on where you are, that a failure is imminent. Again, just as always, the information that the candles give you after the pattern has formed are just as important. The hammer and star pattern is the next one on the list, and this depends on the location. The candlestick pattern forms when there are very large wicks on the tops or the bottoms, depending on if it's bullish or bearish, with the body closing fairly strong near its extreme. Now, the hammer with a full bull body is a strong sign of a breakout failure, right? The market pushed down, it failed, and turned all the way back up and closed bullish. And that is the start with a bear body. It's kind of the same thing, right? Except inverted, right? The wick is all at the top, and it closes at its lows. Now, in best cases, that's where you get the close at the very top or the very bottom. Most of the times it doesn't, but very similar at least. You usually expect a similar result. So keep that in mind. One big thing that we need to look for is that it forms the peak of a move, either the swing high or the swing low. So first of all, we'll look at a hammer pattern example because this is a bullish example. We can see that the market tried pushing lower, they broke underneath that prior candle and completely failed right back up. Now, again, favorably, we would like to see this candle close smack on its highs, but most of the time it doesn't do that. The important thing is that the body doesn't look like this, right? It's not some tiny little body with a bunch of wick on the top. It closed very strong near its highs. It only had a few more ticks to go before it actually closed down its highs. That's a very strong clue that the bulls really just completely shut down the bears at the bottom, and it's giving a potential clue that you're going to at least see some continuation from the buyers trying to push that market back up. You know, again, location is everything. Where are they going? They might just be going to the moving average. They may be going to the highs of that big bear breakout. Regardless, it's showing you clues that the bulls are completely shutting down the bears. And then we have the star pattern, which is the inverted scenario of that. Now, in this case, the bulls tried breaking out very aggressively. They had a strong open. They tried running it very aggressively to the top side, and as soon as they hit the moving average and the area of resistance, it completely fell apart and just dropped all the way back down. And it's denoted by that big wick on the top. They pushed up, they failed, and they closed back down strongly near their lows. Now, this one could close a little bit stronger. I would be even happier, but it still closed relatively strong. It doesn't look that weak. Not all the time do you get a candle that closes like this, right? So in this type of scenario, it's giving you a clue that the buyers have completely fallen apart now, and the bears have a good chance to try to take the market back. And then the final candlestick pattern, the twin reversal pattern. Now, this pattern forms when the market makes a strong push in one direction and then is basically just taken back very quickly in equal strength in the opposite direction. Now, this can show several pieces of information as well. The initial move was seen by the market as a mistake, right? The market pushed up above an area of support or resistance. The market saw that area as kind of a mistake, like, oh, I didn't mean to do that. Sorry, we take it all back. And that completely failed. If it occurred as a breakout, it was very likely a failed breakout, and then the expectation after that is for a counter move being likely. If this occurred around an area of support or resistance, that level is likely holding. It's showing a major failure of traders to try to break out through that level. So here's a good example of a twin reversal pattern. Now, in this case, it's above a prior swing high. We can see that big run lower, formed a quick little bounce there, sellers swarmed the market back again, and it came back to that swing high area. Now, they attempted to break above that swing high area with this strong bull bar, closing outside of that area and closing very strongly. And again, the clues that you get after a candle forms has a lot of information in it. It had terrible follow through. The buyers tried jumping in and were completely slaughtered. They tried again and they couldn't even trigger buyers above the candle before forming the candle that takes it back. Twin reversal candle. Pushes up very aggressively, pushes down below that area, in this case of resistance, just as aggressively, right? If you match these two candles up, this candle here and this candle here, they're very equal in size. They're not exact, but they're very close. The body of the candle is almost identical. The only thing that's different is this has a little more wick on the bottom. So that is a beautiful example of a twin reversal failure of the buyers trying to break out above an area of resistance. They tried, and they failed. Right back down again. Now, this gave huge clues that the market was completely rejecting this area as resistance, and it will likely continue lower for quite some time. So thank you for taking the time to watch the tutorial. I hope it found you well and it helped you learn something new today. Now, you can find tons more information like this on our website, slingshotfutures.com, where we cover all of this kind of stuff through several different means, through all the course material, through the videos, through all of the tutorials that we do, all the way to the live trade room, which is open every single business day, Monday through Friday for the US morning session. Feel free to stop by and just check out the blog too. It's at the bottom of the site. We post daily levels of major support and resistance for that day, and you can use those to trade along with the markets, and hopefully it helps benefit your trading in some way. But hopefully this tutorial found you well, and until the next one, we will talk to you all later. Have a good one.